Most people believe markets react to bad news. Wars, political tension, inflation headlines. That's what they think moves prices. But markets don't actually fear bad news. They've learned how to process that. What markets react to is what hasn't been fully noticed yet. By the time a headline is everywhere, it's usually no longer the risk. It's already been discussed, debated, and partially priced in. The real market shifts tend to happen earlier, quietly, when conditions begin to change beneath the surface, before consensus forms. That's why markets can rise during negative news, or fall when the news flow appears calm. The price action often reflects expectations adjusting, not events themselves. Right now, many investors are focused on dramatic narratives, geopolitical stress, policy uncertainty, volatility across assets. Those stories capture attention, but attention alone doesn't move markets. Repricing happens when assumptions change. Assumptions about inflation, assumptions about liquidity, assumptions about how capital allocates when uncertainty rises. This is where people often get it backward. They look for certainty before acting, when markets are already responding to shifts in probability. So instead of asking, what bad thing might happen next? A more useful question is, what is the market starting to notice, slowly, that most participants are still ignoring? That's the perspective we'll use going forward. Over the most recent trading period, precious metals prices experienced a noticeable pullback from prior highs, following a period of rapid appreciation. This adjustment occurred after prices reached levels that had not been seen historically for extended durations, particularly in silver and platinum. Price movement: silver declined from recent peak levels and stabilized within a lower trading range. Despite the pullback, prices remain significantly higher than long-term historical averages. Gold also eased from its highs but continues to trade well above levels observed earlier in the previous year. Platinum, after a strong multi-month advance from sub-$1,000 levels, has similarly consolidated after reaching above $2,000 per ounce. Timing and speed: the prior advance in precious metals occurred over a relatively short time frame, marked by sharp upward price moves. The subsequent decline was also swift, reflecting normal market behavior following accelerated gains. This type of movement is consistent with periods of elevated volatility, where prices adjust quickly as positioning changes. Market activity at the retail level: physical precious metals dealers reported ongoing activity on both sides of the market. On days when prices moved higher, selling activity increased as holders took advantage of strength. During periods of price softness, buying interest remained present, particularly in smaller denominations silver products such as constitutional silver. Availability of certain items fluctuated, reflecting short-term supply and demand dynamics rather than structural shortages. Comparison to last week and last month: compared with the previous week, prices are lower but have stabilized rather than continued to decline. Compared with the prior month, prices remain materially higher, indicating that the broader upward repricing has not been fully reversed. The current range represents consolidation following a rapid move, rather than a return to earlier long-term price levels. Key takeaway for this section: the market has shifted from rapid expansion to consolidation. Prices have adjusted downward from recent high, but remain elevated relative to historical norms. Trading behavior reflects normal profit-taking and repositioning, rather than a breakdown in market structure. Price consolidation after a sharp advance is not just a pause in movement. It is a process where the market reassesses assumptions. Understanding why this phase matters requires separating headlines from mechanics. First-order effects: positioning and liquidity. The initial surge in precious metals attracted short-term capital. As prices rose rapidly, leveraged and momentum-driven participants increased exposure. When prices stopped accelerating, those positions began to unwind. This created downward pressure, not because fundamentals disappeared, but because positioning became temporarily imbalanced. Liquidity flows, not sentiment, drove the pullback. At the same time, higher prices encourage profit-taking among long-term holders. This selling pressure is typical after sharp moves and helps redistribute metal from weak hands to stronger balance sheets. Second-order effects: behavior and access. As prices consolidated, the market began to change who could participate. Higher absolute price levels reduced affordability for some retail buyers, while increasing interest in fractional and lower premium products. This shift alters demand composition rather than eliminating demand altogether. Institutions and larger allocators, meanwhile, tend to respond not to daily volatility, but to relative value. When metals remain elevated despite pullbacks, it signals that capital is still willing to hold exposure at higher price levels than before. That matters more than the short-term direction. Transmission beyond metals. Precious metals do not move in isolation. Their repricing affects and reflects broader asset allocation decisions. When metals stabilize after a rally, it often coincides with reassessments in currencies, real yields, and risk assets. This does not imply causation in one direction, but it does indicate that markets are recalibrating expectations across asset classes simultaneously. Why this phase is important: consolidation builds information. It reveals where demand remains consistent and where it fades. It tests whether higher prices can be sustained without continuous inflows. Markets that fail this test tend to retrace much further. Markets that pass it often establish a higher reference point for future valuation. At present, prices remain elevated relative to recent history. That suggests the market is not rejecting the new range outright. Instead, it is determining how much capital is willing to stay engaged at these levels. Broader implication. This phase matters because it influences what comes next, not in terms of direction, but in terms of structure. Whether metals move higher, sideways, or lower, the way they behave during consolidation shapes future volatility, participation, and sensitivity to new information. Periods of sharp advances followed by consolidation are not unusual in precious metals. Looking at history helps place the current environment in context, not to predict outcomes, but to reduce emotional bias. When conditions look similar, in previous cycles, precious metals experience rapid repricing during moments of heightened uncertainty, followed by periods of sideways movement or partial retracement. These pauses often occurred after prices reached levels that exceeded what market participants had recently considered normal. In those moments, volatility increased as buyers and sellers adjusted to a new reference range. Examples include prior inflationary periods, shifts in monetary policy expectations, and episodes of currency instability. In each case, the initial price move was fast, while the subsequent adjustment was slower and more complex. What happened before outcomes, not after? Before longer-term trends became clear, markets typically went through phases of indecision. Volume declined, price swings narrowed, and participation shifted. Retail interest often cooled temporarily, while institutional positioning became more selective. Importantly, these transitions happened before any clear resolution became visible in hindsight. This distinction matters. Historical narratives often focus on what prices eventually did, but the decision-making environment at the time was defined by uncertainty and competing signals, much like today. What is different this time? While the pattern of rapid repricing followed by consolidation is familiar, the current backdrop includes structural differences. Global debt levels are materially higher than in past cycles. Financial markets are more interconnected, and information travels faster. Liquidity conditions can change abruptly due to policy communication rather than policy action itself. Additionally, industrial demand for certain metals has diversified compared to earlier decades. This does not guarantee a specific outcome, but it does affect how supply and demand respond to price changes over time. Why history is a filter, not a forecast. History helps identify behaviors, not destinations. It shows that consolidation after strong moves is common and that emotional extremes tend to fade during these phases. It does not tell us whether prices will rise or fall next. By viewing the current environment through this lens, investors can avoid overreacting to short-term fluctuations and instead focus on how the market is adapting to a new set of conditions. At this stage, the most responsible way to think about markets is not in terms of predictions, but probabilities. Rather than assuming a single outcome, it is more useful to outline plausible paths forward and what conditions would need to exist for each to occur. Bull case, strength gradually resumes. If precious metals maintain their elevated price range while macro conditions remain supportive, then a continuation of strength becomes plausible. In this scenario, prices stabilize long enough for positioning to normalize. Volatility compresses, and participation shifts from short-term traders to longer-term holders. Supportive conditions could include stable or declining real interest rates, sustained demand for physical metal, and continued allocation from investors seeking diversification. Importantly, this outcome would not require constant positive news. It would depend on the market demonstrating that higher prices can be sustained without aggressive selling pressure. Strength in this case would likely be incremental rather than explosive. Base case extended consolidation. If current conditions neither materially improve nor deteriorate, then extended sideways movement becomes the most likely path. This scenario assumes mixed signals: modest economic resilience, gradual policy adjustment, and balanced flows between buyers and sellers. Prices would remain within a defined range as the market absorbs prior gains and waits for clearer direction. Historically, this is the most common outcome after sharp advances. Time rather than price becomes the primary mechanism of adjustment. While this phase can feel unproductive, it often reduces risk by resetting expectations and leverage. For long-term participants, this environment emphasizes discipline and patience rather than timing. Bear case, deeper repricing. If conditions change decisively, for example through tightening financial conditions, rising real yields, or reduced liquidity, then a deeper pullback becomes possible. In this scenario, higher prices fail to attract sufficient sustained demand, and selling pressure accelerates as participants reassess exposure. Prices could retrace a meaningful portion of their prior advance, testing lower support levels. This outcome would not imply a long-term failure of precious metals, but rather a reset driven by macro alignment. Markets often overshoot in both directions, and reversals can occur even within broader structural trends. Why scenarios matter? Each of these paths is conditional, not certain. Markets continuously update probabilities as new information emerges. The purpose of scenario analysis is not to choose a favorite outcome, but to understand what evidence would support or weaken each case. By framing the future this way, investors can avoid binary thinking and instead respond to changes with flexibility. Rather than focusing on headlines or short-term price moves, I pay closer attention to a small group of indicators that tend to shape the medium-term direction of precious metals. These indicators help clarify whether market behavior is being driven by structural forces or temporary noise. US Dollar Index, DXY. Precious metals often move inversely to the US dollar, though the relationship is not perfectly linear. What matters most is not the dollar's daily movement, but whether it is trending persistently higher or lower. A stable or weakening dollar tends to reduce headwinds for metals, while sustained dollar strength can pressure prices. Treasury yields and real rates, nominal yields, provide part of the picture, but real yields, adjusted for inflation, are more influential. When real yields rise, holding non-yielding assets like gold and silver becomes less attractive. When real yields stabilize or decline, that pressure eases. I focus on trends rather than single data releases. Inflation data, CPI and PCE. Inflation reports matter less for their absolute level and more for how they affect expectations. Markets respond to whether inflation is accelerating, decelerating, or proving sticky. The Personal Consumption Expenditures, PCE index, is particularly important because of its role in policy discussions. These data points influence expectations for monetary conditions, which in turn affect metals. Volume, liquidity, and positioning. Price moves without sufficient volume are less informative. I watch whether rallies and pullbacks are supported by meaningful participation. Open interest and positioning data help reveal whether moves are driven by new capital or by short-term covering and liquidation. Physical market signals retail demand patterns, availability of products, and premiums offer insight into behavior at the margin. These signals do not dictate price direction, but they help confirm whether market engagement is broadening or narrowing. Why these indicators matter? Together, these factors provide context. They help distinguish between a market reacting emotionally and one responding to shifts in capital allocation. By monitoring them consistently, it becomes easier to adjust expectations as conditions evolve. Markets rarely move in straight lines, especially after periods of rapid change. What we are seeing now is not a conclusion, but a process. One where prices, participants, and expectations are being recalibrated. The key takeaway is not whether precious metals move higher or lower next week, but how they behave while information is being absorbed. Consolidation, volatility, and mixed signals are all part of that adjustment. They do not invalidate long-term theses, nor do they confirm them. This is why risk management and patience matter. Responding to probabilities rather than predictions helps reduce emotional decision-making and encourages consistency over time. Precious metals can play a role in a diversified approach, but that role should be defined by objectives, time horizon, and tolerance for volatility. This isn't investment advice, it's simply how I'm reading the market right now. Staying disciplined, informed, and adaptable matters far more than reacting to any single headline.